Hello everyone, welcome back. My name is Greg Furman, and this is the Forex Weekly Outlook for the week of January the 2nd, 2017. Now, first of all, I'd like to wish everybody a happy new year and a prosperous trading new year in 2017. So with that said, let's get started. Now, when we're beginning our Forex for the year, calendar year 2017, the dollar index obviously is going to play a very, very big role in a number of different pairs in the Forex, but it's also going to affect commodities, stocks across the board. So when we look at things right now, our dollar index here has basically come under a little bit of pressure, very much like what I talked about in last week's Forex Weekly Outlook, that our order flow traders are actually hitting the dollar up in this resistance area here, just above the 103.10, 103.20, 103.30 area, and we're starting to correct lower. Now, what I talked about in last week's Forex Weekly Outlook also was the medium term crossing over the long-term predicted difference, which is a problem for further dollar strength. Now, very thin illiquid markets, they don't carry a lot of weight, but still a very good call from VantagePoint here. And of course, our predicted MACD crossing to the downside, and our predicted RSI here is not breaking below 40, but it is below 50. Now, with the markets closed today, the North American markets, most of your major Forex brokers are closed today. That's why we're doing the Forex Weekly Outlook on Monday instead of Sunday. So we are going to have a bit of a gap in the market. Now, right now, the dollar is actually gaining some strength back. But again, a lot of people are still going to be on holidays this coming week. It's a holiday short week still with Monday trading closed. So we want to take it with a grain of salt here. But the key thing, we want to identify the 18-day predicted moving average, 102.33. We've closed at 102.28, slightly below that area, but not a big deal here. In most cases, the dollar, in the beginning of the year is pretty strong. So we want to look back from 1 year ago. We can see that we actually went sideways to moderately bullish to begin 2016, but then we sold off and basically moved sideways to lower to sideways until about April, and then the dollar regained its composure and rallied right through to December. Now in 2017, we're exactly where we were in 2016, with the Fed talking about 3 potential rate hikes. In my respectful opinion, I'm not convinced we're going to get any rate hikes, and the dollar is just going to continue a very similar pattern. So it's data dependent, but for now, we want to identify the critical levels, and of course that being that critical VantagePoint 18-day predicted moving average, 102.31. So to start the week, that's what we want to look at. And more importantly, we've also got a strong trend line coming in at or about the 102 area, a sustained break of this trend line, and we will see the dollar move considerably lower. Now, with the S&P 500, it is basically about 85% correlated to the dollar index. So the dollar goes down, the S&P is going down. That's what the predominant correlation has been, intermarket correlation has been in 2016. We're going to see if that continues here. So right now, for you equity traders, you are trading Forex whether you like it or not. So our critical level, and again, in last week's Forex Weekly Outlook, I believe the critical VantagePoint level was 22.39, and I suggested prior to this even happening that the market was going to come down to this level, which of course it did, the 22.39 area. So again, all of this is ahead of the market. Nothing is behind the market here. Everything is being forecast before it actually happens. So with the S&P closing out last week, I believe around the 22.60, 22.70 area, the VantagePoint forecast was a little soft on the equities, and again, we saw that medium term crossing over the long-term predicted difference to the downside with this swing top here. That led to basically a breach of that key VantagePoint 22.42 area, and we closed the week here at 22.36. Now, again, I talked about potential with Trump coming into power. There is the possibility here that the tax laws in the U.S. are going to change, capital gains are going to change. So people are kind of holding on to these positions until Trump gets in my respectful opinion, to see what he's going to do with those capital gain taxes. So that's keeping the equities firm here for now, but they are definitely under pressure with our predicted differences breaking below the zero line, the crossover on the predicted MACD, and of course when we connect the dots here, we can see that we've got our swing top here. We've got our 3-day crossing over our 8-day and 18-day predicted moving average. Now, if we follow this down on the VantagePoint forecast on the equities, predicted short, medium, and long-term differences breaking below this all-important zero line with, of course, that medium-term predicted difference crossing to the downside, supporting the trade. Our neural index is down, the crossover on the predicted MACD, and then, of course, the break of the 40 level on the predicted RSI is started to accelerate that equity market lower. Now, we're going to keep an eye on this to start the week, but again, we want to start our trading very lightly. Now, what I also talked about last week is the global equity markets are basically under pressure here. The DAX, we can see the Nikkei, they're all globally connected, the main thing we want to understand. Now, with light sweet crude oil going into 2017, we're basically hung up on this resistance area at $54 a barrel that I've talked about for months now. Well, you can see that we're banging up against this level, but essentially what right now, guys, we are trapped between that swing high and that VantagePoint 18-day predicted moving average at 52.54. If we get a sustained break to the downside of 52.54, then and only then does oil sell off. But right now we are holding above that VantagePoint 18-day predicted moving average after multiple retests, and right now we're all tangled up on the 8-day predicted moving average at 53.32. So oil carrying a moderately bullish tone to it to start the year, but again, I don't see oil going much past $60-65 a barrel in 2017, but again, very, very early to make that call. But for now, oil does carry a mild bullish tone as the RSI we can see is above our 60 and 50 area, but our predicted MACD is very, very sideways here, guys. It's not committing to one side or the other, and the predicted differences hovering right above this zero line. Basically, we are trading sideways on this critical 54 barrel mark. Now, once again, you have to be very careful of false breaks right here. You can see we broke above that $52 or 54 per barrel mark, excuse me, but we immediately retreated back below it here, and we've been trading basically below that area for the last several weeks. So definitely an area to watch around $54 a barrel. If we can break free and clear of this, oil could trade between $60 and $70 a barrel in the first, second, and third quarters, but at this particular time, my optimism on that remains heavily guarded. Now, with our gold trade here, we found a somewhat of a bottom here on gold, what it looks like here. But we're still getting hung up on our key VantagePoint 18-day predicted EMA at 1155. We're only closing at 1151.70. Now again, gold has a very high correlation to the yen, the euro, a number of different currencies, and I'll talk about that in a moment with the euro. But first, we want to understand the critical level. We need to break above 1155 in order for gold to regain its bullish tone here. Now, what would help gold here in this particular case is if we start getting weaker data out of the US and we start getting into another situation basically where we're not getting any rate hikes in 2017, gold will recover. Now, case in point here, because this year is so similar to the beginning of 2016, we can assess here that, again, from a price action basis here, we're almost exactly where we were 1 year ago, very, very close, within $30 or $40 an ounce. Gold basically traded pretty much sideways until about February the 1st, and then the bulk of the gains in gold were made between February and essentially the end of June, and then gold went into its final descent to where it is currently. So again, if we look at a very similar situation that we had in 2016, it suggests that gold could get a boost towards mid to the latter part of January, the first part of February, but right now, again, that depends on incoming data. That means unemployment, GDP, a number of different CPI, retail sales, all of these things factor into that. But, you know, the unemployment is really the one to watch here. Now, as we start to move into our main currency pairs, in my respectful opinion, based around what I understand of the VantagePoint software with these global intermarket correlations, as gold started to rise, basically that we saw the euro start to rise with it. I talked about this extensively in last week's Forex Weekly Outlook, again, ahead of the market, that we would likely have a base here around 103.50 and we would start moving back up to this significant trend line resistance here. Now, the critical vantage point level comes in at 104.96. Let me just clear that again so everybody can see this. So 104.96, the 18-day predicted moving average. We came up and tested that, but at the current time that I'm doing the video, the euro is trading around 104.50 with a slightly bearish tone yet again. But again, we have a massive trend line coming in here right around this area. So we want to make sure we understand that. Now, just to make sure, I'm just going to redraw this back in because I see a mistake here. So I'm going to draw this back in so we can understand exactly where that trend line is coming in at, and that it is at or about the 105.20 area. So a sustained break of 105.20, a close above 125 or 105.25, excuse me, we would then probably look to retarget the 106, 107, 108 area. That's a possibility here. Now, once again, to reaffirm that intermarket correlation between gold and the euro, we can see almost the exact same thing at the beginning of 2016, where the euro basically traded sideways, but then made the bulk of its gains right up until about the end of May, and then the euro started to move lower. Now, there's a lot of sideways chop back and forth here. We can see as the market comes back up, nothing goes straight up and nothing goes straight down, to be very clear. But the main thing we want to understand is where we're at in our trading with this pair right now, one of the most heavily traded pairs in the Forex market. So again, to begin the week, we want to watch the 105.20, 105.30 area very closely, and this critical vantage point 18-day predicted moving average at 104.96. If we can make a sustained break of that area, then and only then will the euro go higher. But we would also be watching gold very, very closely, and the DAX 30. The DAX 30 goes lower, euro goes higher. Gold goes higher, euro US goes higher. So that's the play here, guys, the intermarket correlation. Now, same as US Swiss franc in last week's Forex Weekly Outlook, I drew our trend lines in very closely. I talked about the key vantage point level of 102.11, and if we get a break of this wedge formation, that we would go lower on this particular pair. Now, that has come to fruition. We've had a big spike lower, but then we've recovered and come back up. So 102.11, that's the area to watch to begin the week here. Again, ahead of the market. If we get above 102.11, stay above that level, then longs are back in play. And at the current time, in pre-market trade, in European trade only, US Swiss franc is around 102.40 right now. Most of the Canadian brokers, your US brokers, and even a lot of your European Forex brokers are not open today. So this is what you're going to see around 5 p.m. Eastern Standard Time tonight. You're going to see a gap in the market because there has been some trading. So 102.11 here, guys, we can see that our predicted differences are lower, our strength is lower, predicted MACD. But on our predicted RSI, we're below 50, but we have not broken below 40 here. That is the key thing I want to point out, and that's, in my respectful opinion, is why the US Swiss franc has turned higher again, because we're just trading sideways here, guys, in thin illiquid markets, and now when real money comes back into the market, they're buying US dollars again. So we'll watch this area very closely to begin the week, but a break of the 40 level on the predicted RSI will suggest that the US dollar is probably going to weaken against the Swiss franc. Now, as we get into this coming trading week here with the British pound, US dollar, once again here, guys, ahead of the market. Nothing is late here. It's all ahead of the market. 123.72, the key vantage point 18-day predicted moving average. While we're below that, shorts carry the edge, followed by 123.08. Now, the problem with that, though, is we have a strong trend line sitting at 122. So to begin the week here, guys, and for trading this week, as long as we're above 122, longs carry the edge. But again, I'm forecasting this level ahead of the market. Okay, so on the top side, break of 123.72 would take the pressure off the downside. But a break of 122 would mean that the primary vantage point trend based around this triple EMA cross is remaining to the downside. Now, in last week's Forex Weekly Outlook, I warned everybody about that medium-term predicted difference crossing over the long-term predicted difference. And with my own direct clients, we were heavy buyers of the British pound US dollar last week. That trade did do fairly well. It's come back towards the end of the week, but again, we're stuck below this 123.72 area. At the current time, we're likely going to remain trapped between the VantagePoint 18-day predicted moving average and this lower trend line at 122. Now, if we can break below 122, we need to close below 122 for not just one day, in my respectful opinion, but for 2 days. That would tell me that the downtrend remains firmly in place and sellers have control of the market. Right now, these indicators from VantagePoint are not suggesting that. We can see a rising RSI, our predicted differences are rising, neural index, everything here is pointing to potentially some further upside in the British pound. So the main thing here, guys, is know your levels. All these levels are done ahead of the market. Nothing is late to anything here. It's all forecasting these levels ahead of the market. So when the market comes to these levels, we want to know these levels and be able to react to them, okay? Now, as we come into the dollar-yen pair here, we've got a very, very tight wedge formation on this particular pair. The critical VantagePoint level 116.22, we've come down and tested that at 116.04, and within seconds the market was back up at 117. So this is a classic example of, again, not being late to the market in any stretch of the imagination, but knowing the critical levels and being able to react to them. So when we look at this, if we know the levels of 116.22, we know that right now. If the market comes down to that, we can see a strong trend line coming in at the exact same level. We can attempt to buy off this area. However, if we get a sustained break of 116, then shorts are clearly in play here. So once again, if we're looking at this before the market, for the most part, even opens, and we know all of these critical levels ahead of time, we're essentially waiting for the market to come to us so we can execute a trade. That's the way we do things with the VantagePoint software. So again, we don't want to chase the market here, guys. We want to identify the critical levels and then be able to trade off them. So right now, the dollar yen is actually under pressure, but the VantagePoint 18-day predicted moving average is the only thing saving this pair right now. So if we get a global sell-off in the equity markets, then dollar yen is going to break through 116. At this particular time, there is a better than 50% chance of that happening. Now, if we look at this from 1 year ago here, guys, once again, we were at almost the exact same level. If I just took a line and draw it right across the screen here, you can see that we're almost exactly where we were. I talked about this in last week's Forex Weekly Outlook, that if we can't get above 120, then shorts are a very good play. So with my own direct clients, again, ahead of the market, we were selling heavily into the 118 area. So when we look at this 1 year ago, the yen made the bulk of its gains between essentially February and approximately hit its lowest point after the Brexit at the end of June. And then the yen has been weakening ever since. So its currencies are very repetitive, guys. Incredibly repetitive. So when we look at this, only a sustained break of the 120 level will take the pressure potentially off the downside. Now, the one thing I will point out in 2016 is that we did hit our highest level here at just above the 120, about the 121 area, 120.80. So basically, they had a stop loss hunt for the people that were shorting, flushed them all out, and then they just pounded it straight lower with real price action. So right now, we have not made that new high. The highest we got here was just below the 119 level, I believe, and we've already started our descent. So the equity markets are going to be a determining factor on this particular pair. But for now, guys, once again, ahead of the market, I'm giving you these levels of the VantagePoint level of 116.22 and the trend line support area that comes in at 116. A break of that, once again, the train will be leaving the station here, guys. So get your shorts in. Buy down to the 116, or we break 116, close below that, cut it, go short immediately. Now, When we look at US Canada, again in last week's Forex Weekly Outlook, I clearly warned everybody ahead of the market. Again, we're not late to anything here. We basically identified the level of 130.85 where I suggested shorts are reasonable. If you're going to try and short it, that's where you're going to do it. Now, basically, I made my argument that the VantagePoint medium-term predicted difference crossing over the long-term predicted difference to the downside was one of my main reasons for suggesting that a short could work here, which it did. So the market opened the week down just around the 135 area, went back up to 135.85 twice, and then it failed miserably. So it's very difficult not to make money on a trade like that when you know these levels ahead of the time, and combining that with the VantagePoint indicators and, of course, this Forex Weekly Outlook. So right now the pressure is still not off the upside here for the US CAD, just to be clear. 134.28, you can see we've closed at 134.32, still above that key VantagePoint 18-day predicted moving average. So once again here, guys, US Canada is highly correlated to oil. If oil breaks out above $54 a barrel, closes it, starts moving to $60 a barrel, then US Canada downside will accelerate. But the intermarket correlation that you guys want to watch, rising gold prices, rising oil prices, that will push the Canadian dollar stronger. Okay, so right now, 134.28 to start the week. We're basically right on this level right now here, guys, so it's make or break time. What I will say is I have noticed with the US Canada, it tends to make a top or a bottom on Monday. So watch out for a violent move on Monday and then a potential reversal, but watch the 134.28 area very closely, along with oil and gold contracts. But right now, it is pointing that potentially US CAD could be moving lower. Now, if US Canada moves lower, that will indirectly affect Aussie US and New Zealand US to the upside. Now, you'll remember again in last week's Forex Weekly Outlook, guys, once again, ahead of the market, I identified a critical level of support here. I followed this up with a long recommendation on Australia US last Tuesday night on Trader Planet, supporting my position, which worked out fantastic. Now, the problem is the long trade is still counter trend. 72.73, the VantagePoint 18-day predicted moving average, is the critical level that we need to break above to take the pressure off the downside. So right now we're playing a corrective move up to 73. If we can break above that and close above it, then longs look very good. Now, once again, medium term crossing over our long term predicted difference to the upside on a swing low bottom here. Definitely the long trade was a good one, but we're not getting a big move in Aussie US. The position of the predicted RSI is troubling to me as we came up and tested the 40, close to the 40 level, and then started moving lower. We do not have a crossover to the upside on the predicted MACD, and our neural index has switched back to the downside. So when we combine all of this with more of a yearly outlook and we go back from 1 year ago, we can see that the Aussie had one more push to the downside to the 68 level, and then the bulk of the gains came from January through to May the 1st, and then the Aussie started its descent again. So watch for one more push to the downside, guys, but definitely be on alert for a potential long trade. Now, the exact same thing is going to apply here for New Zealand US. It's basically the same trade. When you're trading these guys, you trade one or the other, never both at the same time. So when I look at this particular situation right now, the key VantagePoint level 69.74, we did come up, and you can see here on the last trading day, we came up to a high of 69.78. So when you're looking at my Forex Weekly Outlook or my analysis using the VantagePoint key 18-day predicted moving average as a pivot area, once again, nothing is late here. We're never late, guys. We know these levels now, ahead of the market. So the market moved up to that level, exact VantagePoint level, and then managed to collapse and drop by about 70 pips. The entire daily range given up, and it closing out at 69.18. Now, we do have a swing low here that we're holding on right now, but keep an eye on 68.50 very, very closely to begin the new year, because when we look at this again, going back, New Zealand US, case in point, how they're virtually the exact same trade. We can see here that we had one more sell-off down there till about February the 1st. Then the New Zealand made the bulk of its gains until actually September the 12th before it gave it back and actually started to move lower. So New Zealand clearly the stronger of the two pairs between Aussie US and New Zealand US. New Zealand US currently is the stronger currency. So once again, we're going to have a choppy start to the week, guys. What I recommend to my own direct clients, let the market settle a little bit for a day or two, get a feel for the levels that I've talked about here in this week's outlook, and try and apply them as best you can.